Sure, I would say that for any asset you own, think of the dilution. So if you're owning fiat currency and the currency supply is growing by 7% per year, you're owning a smaller and smaller share of that network. Um, Equities and real estate have different dilution rates. So, for example, real estate might have a 1 or 2% long-term dilution rate. Gold has something like a 1.5% long-term dilution rate due to new mining. So, for any asset that you consider owning, a first step is to know the dilution rate, both in terms of the number of units, if you can, and also market share. Is it kind of being diluted because it's losing market share in a big thing? So I think the main thing is to own truly scarce things that are then not being diluted. So high quality equities, high quality real estate, precious metals, Bitcoin, whatever kind of how much research they've done, they might be more convicted in certain areas than others.
Every dollar, euro, or pound in your pocket is part of a larger financial network. As that network quietly expands, your share of it shrinks. Inflation is the visible symptom, but the deeper issue is dilution, why holding cash may feel safe in the short term yet erodes value over time. This principle extends across all asset classes. The more units that are created, the smaller your claim becomes. Lyn Alden illustrates this simply, reminding us that every asset, from stocks and real estate to gold and Bitcoin, has a dilution rate. For property, long-term growth might only outpace 1-2% annual dilution, while gold, added slowly through mining, averages around 1.5%. Though these numbers seem modest, compounded over decades, they determine whether wealth grows or quietly diminishes. This is where scarcity becomes crucial. In a world awash with expanding currencies and continuous issuance, the real winners are assets that resist being watered down. Durable businesses, prime real estate, precious metals, and increasingly Bitcoin stand out because they are difficult to replicate. In uncertain times, owning scarcity isn't just an investment, it's a survival strategy, a way to preserve and grow wealth when everything else is being diluted.
Stop. You don't have time. Don't miss out this 2025 bull run. Educate yourself first ahead of the crowd. We have created the ultimate step-by-step crypto cheat guide that will guide you this bull run. Unlock the secrets of crypto and make smarter investments today. Now by clicking on the link below to get your exclusive copy just under $10.
How do you conceptualize Bitcoin? Do you think of it as gold? Do you think of it as money? How do you categorize it in your mind?
In some ways, bigger than that. I view it as money. It's also portable capital. I think more fundamentally what it does is it solves the problem of fast settlements. And so it kind of solves a century and a half problem that humanity's had. So, for all of human history, transactions and settlements were roughly at the same speed. You couldn't really transact any faster than you could move around the world. So transactions happened at the speed of foot and horses and ships. But ever since we invented the telegraph, and specifically when we deployed the telegraph over long distances by the 1860s, we reached kind of this new era where people could communicate around the world at roughly the speed of light and therefore could transact roughly at the speed of light, but we had no fast settlement. So settlement still took the form of literally sending and auditing gold, for example. And so we became reliant for about a century and a half on very centralized ledgers to try to bridge that whole gap between fast transaction speeds and yet still very slow material settlement speeds, any sort of like final delivery. And what is interesting about Bitcoin is that it's basically the invention of fast settlements. It finally allows a value to be sent long distances in a way that's practically irreversible, in a similar way that you chip gold and it gets audited and therefore that transaction's done. It's not resting on a centralized ledger's ongoing maintenance. And so that's basically what that problem solves. But then it's up against very large network effects. So it starts in 2009. It's tiny. It's up against the $100 trillion fiat currency system, and so it's slowly growing into that. Right now, even at a $2+ trillion market cap, it seems big, but it's something like 0.2% of global assets. Gold at something like a 20 trillion network size estimated is around 2% of global assets. So I think Bitcoin is going to grow into kind of the role that gold fills to some extent, but then potentially has a avenue to grow further still because it's able to solve things that even gold itself as a money can't solve. So there's certain things obviously gold can do that Bitcoin can't do. You can use it in industry. It has all these kind of practical purposes, but as a money, Bitcoin is in many ways more powerful. It's able to beam around the world in 10 minutes, even faster by using some higher layers. And I think another way of kind of thinking about it is because especially with your audience and in general, anyone who's technologically minded, our first thought is, well, the first technology is going to be the one that gets displaced. It's going to be some later thing that comes and displaces it. And the way that I've kind of conceptualized this is that the really big exception for that is communication protocols. Those so far tend to have a very long life cycle of lasting. So whether it's Ethernet, whether it's simple mail transfer protocol, whether it's TCP/IP, whether it's USB, once these things kind of become dominant in their fields, they tend to they update over time. So what displaces USB is the next USB rather than literally a competitor. And two, the complexity and the fast moving parts, that tends to happen at the periphery or on higher layers, whereas the core of the system itself is kind of very simple. And I think that Bitcoin is kind of following a similar approach, which is this new communication protocol that exists. And in this case, it's a communication of value. And it's achieved basically network effect dominance. So it becomes increasingly less likely that something within its own field will displace it in a similar way that Ethernet and USB and others have kind of achieved dominance. And therefore, it's going to grow into whatever total addressable market it has, which I think is north of gold's current 2% of global assets.
Bitcoin flips the traditional financial script. It's not just a currency or an investment, it's portable capital that can move anywhere with the speed and finality of a message. No central ledger, no middleman, no permission required. This sets it apart from gold, which is heavy and slow, and fiat, which moves quickly but is endlessly diluted. Bitcoin is scarce, borderless, and fully auditable by anyone. Though it currently represents only a small fraction of global assets, its purpose is clear. It's the first open protocol for money itself, designed to endure cycles and fundamentally reshape how value flows around the world.
Yeah, I don't think it's silly. I think that basically people solve the problem they have. And for most parts of the world, people, when they wake up, they don't have a payments problem. They have a store of value problem. That's something that people in developing countries have. And then even in developed countries, we just have a slower version of it, is where are we going to store our value? So that's something that basically 8 billion people in the world have as a problem. Payment problems, while some people have them, they're way less universal. Most people in developed countries don't think I have all these payment frictions all the time. Now, certain areas do. There has been, for example, debanking. In certain countries, people have the issue. Like I point out that there's over 40 currencies in Africa. There's over 30 currencies in Latin America. So we can imagine in the United States, if every state had a currency, and imagine all the cross-border frictions, not just in terms of payments, but in terms of cross-state lending and things like that. So if an entity in New York wants to lend to an entity in Michigan, and you're balancing 50 different currencies, and so a lot of the world actually kind of lives under that type of friction-filled system. So they, especially in a cross-border sense, you're more likely to have payment frictions. So I think that the problem that Bitcoin is kind of filling into, the thing that it's solving, is more that portable store value problem. So it's portable capital. But then around the margins, it can also solve payment problems for those that have it. But then in addition, that's a crowded field. So for example, stablecoins, not for every person, but for a lot of people, stablecoins solve a lot of their frictions as well. So going back to that example about Africa, like you'll see a lot of stablecoin volumes happening because especially for shorter term holding and paying, stablecoins are equal or in some cases better than Bitcoin at that specific task. And where Bitcoin really shines is that over that long arc of time, it can't really be sanctioned. It's not centralized. It doesn't debase. It's truly permissionless rather than this kind of centralized node on top of a blockchain. And so I think over time it grows into more of that payments aspect. But I think in the current time where it's high volatility and it's growing into its total addressable market, it more serves as that kind of portable capital aspect. So I think it makes sense for someone to do it. I mentioned before that basically in this current system where you have debasing currency, anytime someone can borrow or short fiat currency and go long another asset, as long as they manage risk and volatility well, they get rewarded for it. So I think it makes sense that someone figured that out. You can do it with Bitcoin. It was actually written about by Pierre Rochard back in 2014. He wrote an article called Speculative Attack, and he's like, someone's going to figure out that if you can borrow fiat currency and buy Bitcoin, you're just going to keep doing it over and over and over again. That started happening 6 years later in 2020, and it's been happening ever since. And we're starting to see it in other companies as well. So Metaplanet of Japan, a bunch of others. I think that makes sense. I do think that, this cycle will hit a degree of froth in it. And so some of these levered entities will get shaken out. We've also seen, altcoin treasury companies spinning up, which I think, looking back years from now, will probably not be seen as very positive things to have done to, use leverage to kind of stick altcoins in a publicly traded vehicle. I think basically there's been a long history of, altcoins have one or two good cycles under their belt. When they come out, they get launched, they get hype, but then they kind of roll over relative to Bitcoin and then never really recover. So that's been kind of the case over and over and over again. And I kind of expect that to keep happening just because of that communication network effect aspect that I talked about before. Yeah, I think a lot of them can make good trades, but I think that none of them really have the quality of a treasury asset, which is different. Basically, it's something that I think there's a difference between like a hedge fund holding a trade versus a publicly traded company using it as a long-term treasury asset. I think Bitcoin has met that standard. I don't really view others as having met that standard. I think they're more like penny stock tech plays, basically, where, for example, I'm on the record of being bullish on stablecoins. So obviously, any sort of rails that enable stablecoins to function have some degree of value. So I think it's not to say that there's no value in the space, but generally speaking, it's inflated because there is this really big speculation element and this PvP element kind of built on top of it. And so I think over time, you've kind of seen the narratives play out. And now the narratives in that whole space are pretty weak outside of stablecoins and certain other forms of tokenization. My approach is when I'm very high convicted bullish on something, I size it so that if I'm right, I materially benefit from it. But if I'm wrong, it's not like a financial kill shot. It's just a major setback. And so with Bitcoin, it is my largest individual asset. But it's one of many assets. And there's also a difference between someone who, say sticks half their net worth in Bitcoin versus someone who bought some Bitcoin and then because of superior performance, it's become half of their net worth. They psychologically treat it somewhat different. So I have a lot of Bitcoin exposure, but it's in that kind of broader mindset of more broadly that I want to own multiple types of high quality assets, short fiat currency where I can, or let other, let my assets do it for me on their balance sheets. And I think that, to quote Paul Tudor Jones, I think Bitcoin is the fastest horse in the race. But I don't think it's the only horse. And I think that I have a clearer head by not being 100% in on something. It gives me kind of a Zen aspect in bear markets. So, for example, in November 2022, when Bitcoin had collapsed from 69,000 all the way down to like 16,000, I was at the Pacific Bitcoin conference, and we were having a good time. We were on stage, we were laughing. The energy there was high, and I think because one, people knew what they own, and two, anyone who wasn't levered or didn't size it inappropriately relative to their volatility and risk expectations, use it as a buying opportunity. So I think it makes sense for someone to be all in, but not necessarily everybody, and not even necessarily most people, is how I put it. Another way of kind of pointing out is that Michael Saylor does have other assets in his personal life. He does have properties and things like that. And this particular vehicle obviously represents the vast majority of his net worth. But he'd still be okay if Bitcoin had a problem. So I think people, you want to put yourself in a position where, if Bitcoin doesn't perform the way you think you will, it could be, obviously very damaging to someone financially, but it's not necessarily an irrecoverable thing. If they encounter an issue, and it's going to partially depend on their level of conviction and their level of research that they've done on it. So historically, it has mildly decreased cycle after cycle, and I think that's normal. I think that when you go from a $1 million asset to $1 billion asset to $1 trillion asset, it's naturally that the holding of it gets more diffused, and there's kind of less kind of tail optionality going on. So I think that over the next 5-10 years, I do expect volatility will decrease. And I view it as a good thing because as it kind of gets higher toward its total addressable market, we'd expect volatility to decrease. And also part of why people don't use it for payments at scale is that volatility. So you can't really price things in it because of that high volatility. We still live in a very fiat world. Our liabilities, either in debts or in just ongoing obligations, rent, mortgages, things like that. Our expenses are in fiat currencies around the world. So people can't really price things in Bitcoin. If Bitcoin does get much larger and more liquid and the volatility goes down, that actually opens the possibility where people could price things more readily directly in Bitcoin, especially when you're talking about a context where, a continent with 40 currencies, and it can become more of a standard that people use. So I do expect volatility to decrease, and while the downside is it takes away from the explosive return potential over time, I think the upsides outweigh it. But I also think we have much more to go, most likely, before that volatility gets, to what we consider low, like gold. I think that there's a significant number of people that would spend more Bitcoin if they didn't have this administrative or tax overhead on top of it. That'll be jurisdiction by jurisdiction. So there's some countries that will be ahead of the game in terms of getting away from that, and other ones that'll be more reticent. It also generally should fuel innovation because right now our payment systems are very much permissioned payment systems, and we have software now. We have open source, decentralized, permissionless things to build on, and so tax can sometimes get in the way of that by basically saying that, this would be an easier way to do it, but because of tax, we can't. That's also, I think, part of what keeps stablecoins pretty attractive at the current time, not just the stability, but also because there's less of a tax overhead if you're just using it for holding and spending. But over time, I think that actually will be important. And for example, when people were kind of advocating the government to buy Bitcoin, I think a better policy is to let people use Bitcoin more easily. So I would actually be more interested in the politicians saying we want to, have a certain threshold for which Bitcoin transactions are not taxable versus telling me how much Bitcoin they want to buy on behalf of the government.
Meanwhile, Bitcoin has stabilized above $114,000, supported by surging ETF inflows and renewed institutional interest. Daily net flows exceeding $750 million highlight a shift beyond retail excitement, as corporate balance sheets and professional investors increasingly treat Bitcoin not as a speculative asset, but as a reserve asset. Ethereum has also joined the rally, driven by spot ETF demand that brought in over $170 million midweek. XRP holds around $3, buoyed by strong futures activity, reflecting continued retail conviction. This trend underscores a broader point emphasized by Lyn Alden: the distinction between assets traded for short-term gains versus those trusted as long-term stores of value. While stablecoins and altcoins serve niche purposes, Bitcoin's adoption as a treasury asset signals its evolution into something far more enduring. With the Fed preparing for a potential rate cut and liquidity rising, Bitcoin's march toward $120,000 looks less like hype and more like the gradual establishment of a new financial standard. As scarcity becomes a core defense against dilution, the question remains: do you believe Bitcoin is the ultimate hedge, or do traditional assets still hold your trust? Share your thoughts in the comments below. For more Daily Dose Crypto news, check out these 2 awesome videos on your screen. Click now and we will see you on the next video.